Warren Buffett warning, sell these 7 popular stocks before it's too late. I'm going to tell you something today that's going to make you uncomfortable. And I'm going to tell you anyway because I think you need to hear it. There are 7 stocks that a lot of people own right now that I think are significantly overvalued, not slightly overvalued, significantly overvalued. And I think you should seriously consider selling them before the market corrects and you lock in massive losses. Now, I know what you're thinking. You're thinking, Warren, you never talk like this. You're supposed to be the guy who buys and holds forever. You're supposed to be the guy who stays for the long term. And you're right, I am that guy. But there's a difference between buying great companies at reasonable prices and owning mediocre companies at crazy prices. And right now we have a lot of the second category. Let me be clear about something before I start. This is not market timing. I'm not saying the market is going to crash tomorrow or next month. I don't know when corrections happen. But what I do know is that valuations mean something over long periods of time. What I do know is that when stocks get too expensive relative to their earnings, relative to their cash flows, relative to their intrinsic value, eventually the market corrects. It always does. And the people who own the most overvalued stocks get hurt the most. So I'm not trying to time a crash. I'm trying to protect you from owning stocks that are priced in a way that assumes perfection. Stocks that assume nothing goes wrong. Stocks where the market is already priced in decades of perfect execution. If anything disappoints, the stock gets decimated. I've been investing for over 70 years. I've seen this movie before. I've seen periods where certain stocks or entire sectors get massively bid up. Everyone owns them. Everyone talks about them. Valuations get absurd. And then reality doesn't match the expectations. And the correction is severe. It's painful. And the people who held on lost enormous amounts of money. So let me walk you through 7 stocks that I think fall into this category. And I want to be very clear. These might be decent companies. Some of them are good companies, but they're not good investments at current prices. There's a difference. A great company at a terrible price is a terrible investment. And that's what we have here. The first stock I think you should sell is Tesla. Now, I know this is going to upset a lot of people. Tesla is one of the most popular stocks in the world. Elon Musk is a genius. The company revolutionized electric vehicles. I get all of that. But here's the problem. Tesla's valuation has become absolutely disconnected from reality. The company is trading at valuations that assume it will be the dominant car manufacturer in the world for decades. It assumes it will maintain 60 or 70% profit margins on vehicles. It assumes it will continue to grow revenues at 30 or 40% per year forever. None of those things are guaranteed. In fact, most of them are unlikely. Let me give you some numbers. Tesla trades at roughly a price-to-earnings ratio of 50 to 70 times. That means the stock price is 50 to 70 times the company's annual earnings. For context, a typical S&P 500 company trades at maybe 15 to 20 times earnings. Microsoft, one of the greatest companies ever created, trades at around 30 times earnings. So Tesla is trading at 2 to 3 times the valuation of Microsoft. Does Tesla have a business that's 2 to 3 times better than Microsoft's? I don't think so. Microsoft has an incredible moat. Its products are used by virtually every business in the world. Switching costs are massive. Profit margins are sky high. Tesla makes cars, good cars, yes, but cars is a commoditizing business. As more manufacturers make electric vehicles, competition increases. Margins compress. Tesla's stock price assumes none of that happens. Here's another issue with Tesla. The valuation depends entirely on future growth and future profitability. The company doesn't pay a dividend. It doesn't generate free cash flow. That's particularly impressive relative to its market capitalization. The valuation is entirely based on hope and speculation about what the company will become. That's extremely risky if growth slows by even a little bit. If margins compress by even a little bit, the stock could decline 50% or more because there's no earnings cushion, there's no cash flow cushion, it's all priced into future growth. That's a bet I wouldn't take. The second stock I think you should sell is NVIDIA. Now, I'm going to be careful here because NVIDIA is a fantastic company. It's a legitimate technological leader in artificial intelligence chips, but the stock price has gotten absolutely crazy. NVIDIA trades at over 30 times sales. That means the market value of the company is 30 times its annual revenue. That's nuts. Most companies trade at 1 to 3 times sales. NVIDIA is trading at 10 times that multiple. Why? Because artificial intelligence is going to revolutionize the world. Everyone thinks so, and NVIDIA is the company that makes the chips that power artificial intelligence. So therefore, NVIDIA must be worth 30 times sales. That logic doesn't make sense to me. Here's what I mean. Let's say NVIDIA is the only company that can make artificial intelligence chips for the next decade. Let's say the TAM, the total addressable market, grows to $2 trillion per year. That's enormous. NVIDIA might capture half of that $1 trillion in revenue per year. If they do, and if they maintain a 40% profit margin, they'd make $400 billion per year in profit. That's extraordinary. But here's the thing. The stock market is already pricing in something close to that. The stock price already assumes that NVIDIA will capture an enormous portion of the AI market and maintain incredible margins. If NVIDIA executes perfectly, the stock might go up 20%. If there's any disappointment, the stock could go down 50%. That's a terrible risk reward. When the upside is limited and the downside is massive, you don't own the stock, you sell the stock. This is especially true for a company like NVIDIA, where the competitive landscape is changing rapidly. AMD is getting better at making AI chips. Intel is getting better. Other companies are designing custom chips for their own uses. The notion that NVIDIA will dominate AI chips forever is not guaranteed. If NVIDIA's market share declines from 90% to 80%, the stock probably halves. And yet the current price doesn't reflect that risk at all. The third stock I think you should sell is Amazon. Amazon is a phenomenal company. Jeff Bezos built something extraordinary. The company dominates e-commerce. It dominates cloud computing. It's in 1,000 different businesses. But here's the problem. Amazon stock has gotten very expensive. The company is trading at valuations that assume continued rapid growth. But here's reality. Amazon is a $160 billion annual revenue company. It's massive. The sixth stock I think you should sell is Zoom. Zoom is a great video conferencing company. Absolutely great. During the pandemic, Zoom was essential. Millions of people depended on it, and the stock soared. But here's what happened. The pandemic ended. People went back to the office. Zoom usage declined. The stock collapsed from its highs, but even at depressed levels, the stock is probably too expensive. Why? Because video conferencing is a commodity. Microsoft Teams is built into Office. Google Meet is built into Google Workspace. Cisco has WebEx. Anyone can build video conferencing now. There's no moat. Zoom's advantage was being first and being easy to use, but easy to use is not hard to replicate. Zoom is a one-trick pony that everyone can copy. The competitive advantage is eroding, and yet the stock is still expensive for what it is. The seventh stock I think you should sell is Peloton. Peloton is a cautionary tale. The company made interactive exercise bikes and treadmills. During the pandemic, people were stuck at home. They couldn't go to the gym. Peloton was perfect. The stock soared. Valuation got crazy, but then people went back to the gym. Interest in Peloton equipment declined. The stock collapsed from $140 to a few dollars per share. Investors lost enormous amounts of money, and Peloton is now struggling just to survive. The point here is that there are a lot of stocks that benefited from pandemic trends that are now facing reality. Stocks that were thought to have changed the world forever are actually just temporary winners. I worry that some of the stocks in this list fall into that category. Now, I want to give you a framework for thinking about which stocks you should sell. This is important because I don't want you to just take my word for it. I want you to think critically about the stocks you own first. Ask yourself, what is the price to earnings ratio? If the stock is trading at 50, 60, 70 times earnings, be very careful. That means the market is pricing in perfection. It's pricing in no disappointments. It's pricing in decades of perfect execution. Most companies can't deliver that. Second, ask yourself, what is the business actually doing to generate cash flow? Does the company have recurring revenue? Does it have margins? Does it have a moat? Or is it just burning money on experiments and speculating that something will work? Third, ask yourself, has the valuation already priced in all the good news? If everyone in the world already expects this company to dominate its industry, what's left to drive the stock up? The answer is usually nothing. The only thing that happens is disappointment. Fourth, ask yourself, what could go wrong? What's the bear case? What would have to happen for this stock to be worth 50% less? If the bear case seems plausible, if it doesn't require anything crazy to happen, you should probably sell. Fifth, ask yourself, am I invested in this stock because I think it will make me money or because I'm afraid of missing out? If the honest answer is FOMO, sell. FOMO is not a good investing strategy. Let me also talk about why valuations matter. I think there's a misconception that valuation doesn't matter, that if you buy good companies and hold them forever, you'll do fine regardless of price. That's wrong. Valuation matters enormously. A stock purchased at a reasonable valuation will return significantly more money than the same stock purchased at a ridiculous valuation. An investor who bought Apple in 2003 at a reasonable price and held it for 20 years made extraordinary returns. But an investor who bought Apple in 2020 at a valuation of 30 times earnings is probably going to make very modest returns from that point forward. Because the low-hanging fruit has already been picked, here's the math on this. Let's say a company grows earnings at 15% per year for 10 years. That's outstanding growth. At the end of 10 years, earnings have increased by about 400%. Now, if the stock trades at a reasonable valuation of 20 times earnings at the beginning, it might trade at 25 or 30 times earnings at the end because the market perceives lower growth ahead. So a stock purchased at 20 times earnings might only be worth 25 or 30 times earnings in 10 years. The earnings quadrupled, but the multiple barely changed. Stock price increases by about 5 times. That's great, but if you buy at 60 times earnings and the stock ends up trading at 25 or 30 times earnings in 10 years, even though earnings quadrupled, you've actually lost money. The earnings went up, but the valuation compression more than offset the earnings growth. That's what happens when you overpay. I also want to talk about something that troubles me deeply: the prevalence of investing in stocks you don't understand. People own Tesla who can't explain how Tesla makes money. People own NVIDIA who can't explain what NVIDIA's competitive advantages are. People own Meta who can't articulate why Meta's stock price should go up. They own these stocks because they're hot, because everyone talks about them, because they've gone up a lot, but that's exactly backwards. You should only own stocks you understand. You should only own stocks where you can articulate the business model, the competitive advantages, and the valuation. If you can't do that, you probably shouldn't own it. Here's what I would do if I owned any of these 7 stocks. First, I would honestly assess my thesis. Why did I buy this stock? Has anything changed? Am I still confident in the thesis? Second, I would look at the valuation. Is the stock trading at a reasonable valuation, or has it gotten expensive? Third, I would consider the alternative. Is there a better use for this money? Is there another stock that's cheaper and has better prospects? Fourth, I would make a decision. Either I increase my position because I'm confident and I got a better price, or I reduce my position because I think the valuation is crazy. I don't just sit and hold regardless of valuation. I want to address something about selling. A lot of people feel like selling is admitting failure. They think that if they sell a stock, they're missing out on future gains. That's backwards thinking. Selling a stock that's overvalued is not failure. Selling a stock that you no longer understand is not failure. Selling a stock to realize tax losses is not failure. Selling is a tool. It's part of managing a portfolio intelligently. Sometimes the best investment decision is to sell. Here's what I tell people about selling. First, selling a stock should reduce your emotion. If you're selling because the valuation got too crazy and you're afraid it will decline, selling should make you feel better. It should reduce your stress. If selling doesn't reduce your emotion, maybe you shouldn't sell. Second, selling should be based on analysis, not emotion. You should have reasons for selling and the valuation is too high. The thesis changed. I found a better investment. You should not sell because the stock went down and you're scared. Selling on fear is usually wrong. Third, selling should be followed by action. Don't sell and sit in cash. Redeploy the capital to something better. Otherwise, you're just locking in a loss and hoping for a recovery. Now, let me talk about what you should do with the proceeds from selling these overvalued stocks. You have options. First, you could move into more reasonably valued stocks. Stocks like Procter & Gamble, Johnson & Johnson, Coca-Cola, Duke Energy, stocks trading at reasonable valuations with strong fundamentals and proven business models. Second, you could move into dividend-paying stocks that generate income while you wait for the market to correct. Third, you could move into index funds. If you can't pick individual stocks, just buy an index fund. At least you'll get reasonable diversification and not be betting the farm on a few overvalued stocks. Fourth, you could hold cash. If you can't find attractive investments, hold cash and wait. Cash is a position, it's not a failure, it's a choice to not take risk. I want to be very careful about one thing. I'm not saying the market is crashing tomorrow. I'm not saying there will be a big correction next week or next month. I don't know, but I am saying that excessive valuations eventually correct. That's just how markets work. And when they do, the most overvalued stocks get hit the hardest. So if you own stocks that are trading at 50, 60, 70 times earnings, I think you should consider reducing your position, not necessarily selling everything, but reducing, taking some profits, moving into more reasonably valued alternatives. Let me also talk about something that's been troubling to me, the amount of speculation in markets today. People are buying stocks they don't understand from companies they've never researched at prices they haven't analyzed. Based on hot tips they read on social media or heard from a friend, this is not investing, this is gambling, and gambling doesn't work as a wealth-building strategy. Real investing requires discipline, patience, research, and analysis. It requires thinking independently. It requires not following the crowd. If everyone thinks a stock is great, that's a red flag, not a green light. Here's what I think about the 7 stocks I mentioned. Tesla might be a great company in 20 years, but that doesn't mean it's a good investment today at current valuations. Nvidia might dominate AI chips for a decade, but that doesn't mean the stock will make you money at current valuations. Amazon might do great things, but valuations matter. Meta might figure out the metaverse, but the risk-reward is bad. Netflix might adapt and thrive, but the moat is eroding. Zoom might remain a leader in video conferencing, but commoditization is happening. Peloton might survive, but it's probably not worth much. The point is that great companies can be terrible investments at the wrong price, and bad companies can be good investments at the right price. Price matters. I also want to say something about the average investor. Most people can't beat the market by picking individual stocks. It's just too hard. You're competing against professional investors with billions of dollars in resources. You're competing against algorithms that analyze thousands of data points per second. You're competing against people who dedicate their entire lives to analyzing businesses. For most people, the best approach is to buy index funds, not try to pick individual stocks. If you do pick individual stocks, do it with a small portion of your portfolio and only with money you can afford to lose. But if you are going to pick individual stocks, at least be disciplined about it. At least require that the stocks you own are trading at reasonable valuations. At least require that you understand the business. At least require that the risk-reward is favorable. Don't just buy hot stocks at ridiculous prices. That's the path to losing money. Let me give you some specific guidance on valuation metrics. Price to earnings ratio, or PE, should typically be between 10 and 30 for most stocks. Below 10 is rare and usually means something is wrong. Above 30 means the market is pricing in a lot of future growth. That's where you need to be very careful. Price to sales ratio should typically be between 1 and 5. Above 5 is expensive. Below 1 is usually a value opportunity. The price to book ratio for non-financial companies should typically be between 1 and 4. Free cash flow yield should be at least 3 to 4%. If a stock is generating 1% or less free cash flow yield, you need to understand why before you invest. Dividend yield should be between 2 and 5% for mature companies. Zero dividend and sky-high valuations is a dangerous combination. I also want to talk about something that's been happening in markets, the concentration of gains in a very small number of stocks this year. If you look at the major indices, the returns have been driven almost entirely by a handful of mega cap technology stocks. The 7 stocks I mentioned are part of that group. That concentration is dangerous. It means a lot of investors have a lot of money in a small number of overvalued stocks. If those stocks correct, there's going to be a lot of pain. Diversification is not just about not putting all your money in one stock. It's about not putting all your money in a handful of expensive stocks. You should have exposure to different sectors, different valuations, different countries. Here's what I would build if I was starting a new portfolio today. I would buy a core position in an index fund that tracks the S&P 500, that gives me broad diversification. Then I would add some specific positions, some dividend-paying stocks like Procter & Gamble, Johnson & Johnson, Coca-Cola, some value stocks trading below book value with good cash flows, some international stocks for diversification, some bonds for stability. I would not concentrate in a handful of overvalued technology stocks. I would not chase hot stocks. I would build a diversified, reasonably valued portfolio, and I would hold it for decades. Now, I want to address the argument that I always make for holding forever. Some people say, Warren, you always talk about holding stocks forever. Aren't you contradicting yourself by saying to sell? No, I'm not. There's a difference between holding great companies and holding overvalued stocks. I own Coca-Cola. I've owned it for decades. I will probably own it until I die. But I didn't pay 50 times earnings for Coca-Cola. I paid a reasonable price. I bought when the market was worried or when I got a good entry point. Holding forever makes sense. When you own a great business at a reasonable price, holding forever is a mistake when you own an okay business at a crazy price. The bottom line is this: look at the stocks you own, be honest about the valuations, be honest about the business models, be honest about the competitive advantages. If you own stocks that are massively expensive with unclear moats dependent entirely on future growth, I think you should consider selling at least some of your position, lock in some gains, move into more reasonably valued alternatives. This is not market timing. This is common sense. This is protecting yourself from the inevitable valuation correction that's going to happen. Remember, markets are cyclical. Right now, we're in a period where growth stocks and technology stocks are expensive. That doesn't last forever. Eventually, the cycle rotates. Value stocks, dividend stocks, boring old stalwart companies come back into favor. And when that happens, the investors who bought overvalued growth stocks at the peak are going to regret it. But the investors who sold at reasonable prices and moved into cheaper stocks are going to do well. Let me make one final point. There's no shame in making a mistake. If you bought Tesla at $200 and it goes to $500, that's great. You made money. But if you keep holding at $500 waiting for $1,000 and it drops back to $200, that's not holding forever. That's ignoring valuation. That's greedy. That's emotional. Take your profits, lock in your gains, move into the next opportunity. That's how you build long-term wealth, not by riding winners to the top and then holding all the way down. If this content has been valuable to you, if you understand now why valuations matter and why you should consider selling overvalued stocks, I need you to do something for me. Like this video. Hit that thumbs up button. Let me know you found value in this content and subscribe to this channel right now, because I'm going to keep bringing you content about investing, about valuation, about how to think like the best investors in the world. New videos every single week. Don't miss a single one. Turn on notifications so you're alerted the moment I post a new video. Leave a comment below. Tell me which of these 7 stocks you own. Tell me if you're thinking about selling. Tell me what's keeping you invested in overvalued stocks. Tell me your thoughts on valuation. I read every comment and I respond to as many as I can. This is a community, and I want to hear from you. The stock market will correct eventually. That's inevitable. The question is whether you're going to be one of the people who gets hurt by that correction or one of the people who's prepared for it. It all depends on the decisions you make today about which stocks to hold and which to sell. Make smart decisions, think independently, require reasonable valuations, and you'll do well. Thank you for watching. I'll see you in the next video.